Hi there, my name is John Maher. I'm the Chief Investment Officer at CCR Wealth Management, and thank you for tuning in. This is a very brief summary of CCR Wealth Management's outlook, which went out in March, and just a couple topics I want to follow up on. As we wrote last month, the world has been digesting a lot of news. A lot of it has been with regard to international developments. Certainly the U.S.-China trade relations have been foremost. The Brexit kind of convulsions have continued, and we have also been experiencing global GDP growth slowdown. So these are some of the topics that we touched on with regards to CCR's major move, which has been a move away from non-US equities. It's important that I mention this because the question has been asked. This is not a defensive crouch on our part. We are global investors. We seek opportunity globally, but we're also tactical investors, and we're going to seek opportunity where the opportunity is most likely to occur. As we look around the world, we see GDP forecasts in the United States 2 to 2.5%. In Europe, maybe 75 basis points to 1.25%. Japan, 1% at best. So clearly on that basis, the United States is the cleanest shirt in a pile of dirty laundry, a term I've used before. We also discussed last month the evidence that's there with the purchasing managers indexes around the world. And there is a clear negative trend almost everywhere we look in the developed world, with the exception of the United States. This is very important, this is not a shift away from equities on our part. It is not a defensive crouch. We remain engaged in equity markets with $1 trillion of private equity money on the sidelines in the United States. We think M&A activity could actually be picking up in the near term. Let's face it. 2 to 2.25% economic growth. It's kind of tough to grow the top line if you're a company. And that's why we think that there's going to be a lot of M&A activity seeking inorganic growth in that manner. On a positive note, I think one of the most seminal shifts that we've experienced in the market over the last few months has been the Fed's turn to a much more dovish standpoint. So taking rate hikes off the table probably through the end of this year, and possibly looking at the possibility of rate cuts next year seems to have gotten the market out of a bit of a funk. So we characterized ourselves last month as cautiously optimistic. But I'd make one last point here, and that is, while we are cautiously optimistic and we do believe that the United States is on solid economic footing, investors should take note that as I'm speaking on April 15th, the S&P 500 is up 16.67%. This implies, if you're to do the math, that the calendar year 2019 is going to experience an over 62% rate of return. We find this highly unlikely. So this leads into an obvious forecast of increased volatility this year, and we expect we expect much more give and take in this market than we've experienced in the first quarter. So investors, beware, adjust your expectations, and thank you for tuning in. We'll talk to you the next time.